I'm Lon Shaver, Vice President with Silvercorp Metals. Silvercorp Metals is a diversified precious metals producer. Main assets are operating mines in China that produce silver, lead, and zinc. We also have a significant investment in other companies, including New Pacific Metals, which has a very promising portfolio of projects in Bolivia. And we have a large cash balance, which we'd like to deploy for new growth opportunities in the precious metal space.
Lon, good to speak to you. I think we spoke first about a year ago, actually. So thanks for coming on the show. Do appreciate that. Intrigued about the story because the geopolitics of the moment mean that people are concerned about jurisdictional risk. In fact, trying to define what tier one jurisdictions mean anymore. You appear to be a Chinese silver story. Is that right?
Well, we're a Canadian company, and our current production comes from mines in China, but we have other assets that I think in the overall mix mean that we're not just a Chinese silver mining company.
Right, but your money comes from the operations in China. You get three assets there that people will point to, and and I know you're trying to now tell me that you've got other options available to you, but your fortunes are linked to those mines in China, though. So is it fair for people to kind of judge you on that basis?
And then that's been a very profitable business, and that's what's allowed us to grow this asset base without having to dilute equity shareholders by issuing more shares.
Right, but if I look at your share price then since mid 2020, it's been a sort of steady climb down. And what do you put that to? What do you put that down to? Is it? Do you think it's the China factor? Is it the silver price, the precious metal price market more broadly? I mean, what's at fault?
Well, I think after that run up in 2020, I think everyone has come under some pressure. But I do think the pressure has been amplified because of that perception of being in China. And I think with sort of what the political tone has become starting in late 2020, I think that has weighed upon us. But I think that it's a bit overblown from a perception standpoint.
Perception's reality, right? So is it overblown, or do you think people are putting too much store by that? So why should they not be concerned about the Chinese factor, especially in light of what's going on with Russia, Ukraine, etc.? Can Canadian companies operate safely in China? Will your businesses be disrupted at any point in the future?
Well, I think to ask that question, I think one needs to look at other companies in other sectors that also have significant investments in China. And so things like Tesla have made big investments. They have probably more interesting assets for a government that might want to exert control. There's other companies. I'll give you an example. There are other companies, U.S. companies in China. Johnson Controls has a car battery plant. So we produce lead concentrates. They get fed into the domestic smelter stream that produces finished lead. What if some of that lead ends up in a car battery plant owned by Johnson Controls? Is Johnson Controls being penalized by its shareholders for having a battery plant in China? I think so. It's just really the investor community isn't taking the time to look in and realize all the amount of assets, investment, and financial return. Everyone's familiar with Apple. Where would they be without Foxconn producing all the componentry that goes into an Apple phone? But I don't think Apple gets a Chinese discount.
Right. Okay. So we're saying Chinese, first you're concerned, and those examples, so this companies operating successfully in China. So perhaps it is overblown. People's perception about the Chinese risk is overblown. Talk to me about the numbers then, because then what I need to understand the fundamentals to your business. Like say, it's in a very meaningful way. I don't really need to understand. Can you mine? You can mine. You're mining. You're selling metals, and you're making money. So talk to me about the financial situation and what it contributes, and then perhaps we'll lead on to what do you do with that money? So if you don't mind.
Yeah, I mean, most recent financial year that ended in March, revenue just over 200 million. EBITDA just under 100 million, operating cash flow of 107 million, free cash flow between 45 and 50 million, US. And that's really like a track record that goes back starting when the mines were acquired and developed, going back to 2004. So there's been, if you look through the financial results, there's been a long history of profitability, generating positive cash flows, and building up an asset base, which is why we have 213 million in cash. We haven't raised any equity since 2010. So where did that cash come from? It came from the solid fundamentals of the business.
Right, and where's this money sitting? Because obviously, I know you're doing share buybacks, you're doing dividends, but are you able to extract money out of China easily? If I looked at some of these South American stories, people can say, I can't get my money out of Argentina, I can't get my money out of, well, fill in the blank South American country. So it's okay for you guys?
Yeah. I mean, it's very straightforward. Anyone who looks through the financial results will see there's a 25% income tax rate. Subject to some rebates we get for being classified as a high-tech enterprise. And then there's a 10% withholding tax for funds that get flowed out of the country. And so it's quite straightforward. And our cash is, our actual cash is held, some of it within China, some in other parts in Asia, and some in North America. So that's not really a concern. If we had things that we wanted to do with that cash, like we did in 2010 when we attempted to make an acquisition of a gold project in South America, that cash would be available for us.
Right. Okay. So I guess, like I said, I'm not necessarily concerned about you telling me that you're good at mining. What I want to understand is how long does this kind of annuity stream of cash continue? What's the life of mine? What's your exploration program in terms of extending that life of mine look like?
I mean, for an underground, narrow vein, high grade underground mine, we have an exceptional mine life. For the Ying mining complex, which is the biggest asset that we have, based on the last technical report on reserves alone, it was a 20-year mine life. So we're not really worried in terms of mine life. And we've actually, in the last 2 calendar years, at Ying, did 630,000 meters of drilling, following up on some new clues and some new discoveries, including some gold zones within the footprint of our existing mines that we're looking to bring on stream and expand our production.
Okay,
profile.
So you believe that the revenue stream is sustainable for some period of time? I'm assuming the BYP and the GC mine, similar work being done there, is there? Yeah,
I mean, BYP is an exception. It's on care and maintenance right now. And it is a mine that we're looking to reopen. It used to be a lead and zinc operation primarily, but we've identified a gold resource. And when we get that permitted, we'll have more clarity on bringing that back into production. But the GC mine is very similar to Ying in terms of the silver, lead, zinc that it produces. And it's got a mine life not quite as long as Ying, but it's a very healthy 13 plus years based on the last report.
Okay, so if I look at the cash that you're producing, and I think lots of questions sent in around, well, what are you going to do with it? So like I said, share buybacks and dividends, much appreciated, I'm sure, by your shareholders. But do you reinvest into China? Do you, and again, sorry to bang on about jurisdictional risk, but in this market, I think it's appropriate. Do you invest outside of China? And if so, where? And, what sorts of targets are you looking at?
Yeah, I'd say both in terms of investment. So we're really going to look at and go where the opportunities are. So there are some opportunities in and around where we're active in China, but I'd say mainly our corporate development initiatives are looking outside of China, in the Americas, in Africa, primarily these days. And that would be looking at silver, but also at gold projects.
Right. And so this is a bit more of a generic one, but I wouldn't mind your input here, because we've had interesting discussions with various CEAs on panels and so forth about, what defines a tier 1 jurisdiction anymore, when you kind of got some of the, NGO activist type activity going on down South America. You could argue the same thing in Canada. It's got a little bit more expensive and a little bit more difficult to get permits and licenses in some states in the US. Does that kind of skew your thinking, or is your thinking adapting to that knowledge and saying, well, actually, do you know what, China, whatever people may think, may actually be a better place to do our business?
I mean, I think every jurisdiction has its pros and cons, and certainly where we're active in China, we've got good relationships. I think we can move things forward, but there's bureaucracies everywhere that you have to deal with, and so I think that's where sometimes some of these safe jurisdictions are really not as safe, because if you get hung up for 2, 3, 4 years longer than expected in a permitting process and blow your budgets out, I think that's where you lose your return on these projects. Other jurisdictions that are maybe not or are perceived as more risky, you might be able to get traction and get a license to operate and move ahead and start to deliver economic returns on the project sooner. So I think we're open to that and look at everything on a case by case basis.
Okay, and if I kind of go to some of the conversations that I've had with various companies, they kind of look to China and they kind of they're less than complimentary about doing business in China in terms of the ethical standards applied. So in the context of ESG, is China any different from anywhere else in terms of their demands of the mining and extraction industry?
Actually, I think if you spoke with our operating colleagues, the standards and the scrutiny and the oversight and the degree of red tape is very high. And it's really because of the size of the organization and the focus that we've had, in the 17 plus years we've been operating, that we've been able to adapt and follow along with a lot of the new regulations. And that's why all of our mines have this green mine status, which is really a requirement to be operating in China these days.
Right. Okay. No, so I'm always intrigued by that, because I think there's a tendency to kind of show sort of rather grim images of, and certainly like things like rare earths industry, extraction industry. It doesn't look pretty, but so and he regulates that. Is it again on a province by province basis?
It's a range. I mean, there's from that green mine program I was describing, and there is a provincial level green mine, and then there's a national level. But as it relates to the operations themselves, I mean, there are different oversight boards related to environmental, health and safety, all different types of regulations. And, we deal with a lot of inspections and visits to review things. The amount of integration in terms of information, just by way of example, our tailings dams have, seismic monitoring to see if there's been any ground movement. Those are actually wired in, and the information is fed directly to the regulators at the same time as it's fed to our teams. And so the minute something might happen, the phones are ringing in everyone's office at the same time. And there really is, to be honest, quite a collaborative effort to work on, remedying anything that may come up. I think the one thing that's missed is that the regulations, in fact, have always been in place and have been there. But what has been lacking in past years has been the enforcement and the monitoring. And what's happened in recent years with the change of government at the top level has really been a focus on eradicating any kind of corruption or sloppiness in execution and monitoring. And so that's what we've seen as an organization, is that the amount of interaction and monitoring review has gone up immensely.
Okay. Let's come back to the share price, right? So I make money when I invest in a company and the share price goes up. I appreciate dividends and I appreciate share price can help, but that's how I as a retail investor would make money. So given the optionality you have with cash and the fact that you are creating cash, you're a net positive cash creation company, you've got your new Pacific option. You've got cash to make acquisitions. You've got cash to do exploration at your current operating mines. But in a market like this, where when companies make announcements, the market shrugs its shoulder and go, I kind of don't care, right? So that's the current market. But even before that, it was, you're on a downward trend. What do you think you need to do? You've been a markets guy for a long time. What's it going to take to kind of change the direction of the share price? And to that end, do you think the market is valuing you properly at the moment on the basis of the fundamentals which you're showing?
Well, I'd say to the second question, no, I don't think we're being valued properly. And I do think what is required is to find an investment that we can make to deliver good financial returns like our other assets have been. And some of the commentary about what we could do with the cash is a little bit of the because I see the I see the commentary as well, and people always ask the question about dividends and the buybacks or a special dividend. The challenge with that is right now we do have three major assets that are contributing value to the company. If we do something with that cash in terms of a buyback, a massive buyback, or a big special dividend, that's kind of a one-time deal. It's like that whole thing of if somebody's hungry, do you buy them a fish or do you teach them to fish? I think if we use that cash and we acquire a business that can again deliver long-term returns, that will be a better result for shareholders in the end, rather than just deploying it and then losing one of those value contributors in our business.
Right, but what does that mean though? Does that mean if we did go out and buy something, do we go and buy a development company where we can use our balance sheet to get that through into some kind of robust production and therefore cash flow? Is it, well, let's just reinvest organically into what we've already got, and that story will grow? I mean, what precisely are you advocating?
Well, I think we can do both. I think we can reinvest organically, and that's what the benefit of those positive cash flow businesses that we have. But ideally, we would like to deploy that into a development asset that we can build another source and diversify our cash flow streams. Build another source of cash flows, based on a solid mining asset, and that's what we set out to do in 2020 when we negotiated the deal to acquire Guyana Goldfields. We saw an excellent development asset. We saw a challenged company with an open pit transitioning to an underground development model that we thought would be a great fit for us. And it's the bulk of what we looked at in 2021 when we signed over 30 CEAs and looked at 30 different projects in depth in that year.
Why did these things fall over? I mean, I had one CEO come on here and say to me, I am currently in the process of looking at 35 different economic studies. I'm talking about definitive feasibility studies. He said, but 5 of them are investable, because the economic studies don't actually always mean economic in a conventional sense. In the sense I'd want to invest in them. Are you rejecting a lot of these CEAs, or is it just competitive out there? Or I mean, how do they fall over?
Well, I think there's a few questions in what you've asked there. When we look at things, we obviously take a good look at geology, because geology will be a big determinant in the margin that you're going to derive from an operation. So we look at that in depth. But I also think the model is a little bit broken in terms of the junior mining space, because you can drill off, you can identify a resource, you can, based on sort of what the appetite of the market is, you can shift that resource to make it look, bigger and lower grade, and get engineers to deliver you a project that will, give you the results in terms of headline numbers of ounces and apparent economics. But then when you get in and you're the group that actually has to live with it and build it, you realize that the work that's been done has been pretty superficial. So we actually, when we look at things, we really don't put a lot of weight on the existing studies. We really take a ground up, starting from scratch approach, going back to the raw geology. And then we'll build our own models and our own mine plans, our own CapEx budgets based off of that.
It's interesting, isn't it? It's an interesting I guess a conversation for another day, potentially. But the kind of re-rates that companies get as they move through those kind of study phases. But the reality is somewhat different if you're talking to a bunch of mine builders, because they see what the problems are and what the opportunities are.
And I think you can tie that right back to what you see in the marketplace, which is the fact that the projects that have been identified and are moving ahead, how many of them really are delivered on time and on budget, and how many of them actually, when you try to get to the project that you said you're going to deliver, the cost, the timeframes, the results are nowhere near what you expected.
Yeah, I know, it's fascinating. Okay, and kind of just in terms of combining the kind of China factor with things like inflation, are you guys seeing on the ground your costs rising as we're seeing out here in the West? I know there's a lot of kind of price gouging and opportunistic movements, but is it predictable in China, the cost side of things?
I mean, I think there is some cost pressure. I'd say that cost pressure is less, just given the proximity to the numbers of different suppliers of goods and services that we rely on. We've certainly seen the changes in currency have an impact, and most recently that's been an improvement for us. So costs in U.S. dollar terms, have gone down. With the weakening of the RMB that we've seen, this spring. Where we've seen some cost pressure has been certainly in labor costs, but ironically, the situation in China with property development coming off has meant that there's a lot more people available that used to be involved in construction. So those are, again, labor-intensive, heavy industry type jobs that aren't being picked up right now. So that's probably a bit of an improvement for us. I'd say, though, overall, just being in China helps to insulate us a little bit from some of the costs that people in the West are seeing.
Right, and what about energy costs? Because I'm sort of intrigued about, again, the geopolitics, because you're in the mix there. Oil and presumably gas in greater numbers soon from Russia at a discount, one assumes. Are you benefiting from that yet?
I can't say I've seen any detailed studies in terms of what the costs are. I'd say, if anything, though, I mean, what we're doing as a company, like most of our peers, is looking at, how do we shift, how do we electrify, where's that electricity coming from? There's a big push to become bigger in terms of the renewable space. So I guess it's a bit of a race to the end here as to, what hits first, higher prices in terms of the fossil fuels, or are we able to get to more electrification?
Right. And okay. And just, again, so I'm bouncing around a bit here, but I'm just so intrigued about how you guys think about things like this, because it's, like I say, we don't need to focus on the mining bit. We focus on all of the other variables which affect your margins, because your focus is, very much on free cash flow. So silver market has, well, it kind of stalled. I think it's fair to say, as has gold. Expectation is it should be way, way higher, but it's not. Are you at all concerned about that one, or these prices? Are you happy? I mean, how do you view the market?
Certainly not as happy as we were before. I can't say we're concerned looking at, or as concerned as maybe some of our peers would be, given our better cost structure. I think just being a mining company and as a price taker, we just have to constantly looking at how do we trim back and focus on maintaining margins in any way that we can. Circling back to one of your previous questions, though, is given our cost structure. I do think that we represent a defensive way for investors to gain positioning in the precious metals and silver in particular. Just when you look back at sort of what the peer group had to do during that nuclear winter, how many shares got issued to put cash on the balance sheet, even when silver prices were lower than they were now, we were making money and accumulating cash. So I think that's something that we have as a bit of a backup plan, but obviously we'd like to see commodity prices higher, and are optimistic that this is a bit of a blip that we're experiencing right now.
But do you think that the kind of old rules don't apply anymore? Because it's kind of like there's a expectation if the markets. Historically, if the markets were doing the sorts of things that they're doing at the moment, the geopolitics doing what it's doing at the moment, precious metal markets should be, well, on the up. Let's put it like that. Whatever number you want to put on that, something conservative or something extreme, they should be moving in these markets. So, why do you think things are discombobulated?
Well, it's funny, you use the word, and we talked about this word should. It's a great word. You used that twice in your last question. And I certainly agree. I think it should be higher. I think what happens in these times of turmoil, I think people are really looking at safety, security, and selling everything that has any kind of liquidity to it. And so I think that's weighing on commodity prices and the precious metals in particular right now.
Right, but do you think there's a kind of component of this uncertainty in the marketplace? Obviously, look, you're big institutional kind of components of what you do, but the retail component that you have is there for liquidity, and that kind of helps things immensely. Do you think it's not just kind of risk off because I'm concerned about what the government's going to do? It's risk off because I'm concerned that I just don't have the same disposable income discretionary spend that I once did. That's what's making me nervous.
Well, I think that's the case. I just look at what's happening in the equity markets, the cryptocurrency markets, the concern about real estate markets. I mean, I think people are going to be making those portfolio readjustments across the board, given what's going on.
But will it come back? Will it come back though, Lon?
Well, I think it will. I think it will. It's just a factor of getting people, getting their sense sorted out, and what are the governments doing with respect to rates? What are they going to do, trying to balance that and also provide stimulus to avoid a recession? All of these things right now, I think, lead to a lot of questions and uncertainty, and that's the challenge.
Right, and sort of sorry to kind of get into things like this, but given the amount of cash that you're throwing off, and given the kind of vagaries of the market at the moment, and it's been a couple of years of sort of downward pressure on your share price, your institutional shareholders, they must be talking to you. They must be asking, what next, and are they making demands of you at the moment? And does part of that make you think, well, why be public anymore? We're at that point where maybe we can go private.
Yeah, I mean, I think anyone can ask that question when you look at that valuation scenario that we're facing, given the market cap relative to those other assets. I think people, though, who follow and understand the company aren't really asking the questions because they know that we are caught up in what's happening to our entire peer group for the most part. As we talked about, maybe amplified a little bit because of the additional perceptions on China. But I think what we've set out to do, we've been consistent. We've not gone out and done bad acquisitions just to deliver an acquisition to the market, but we are looking. We would like to find something, and there's definitely catalysts down the road here. And obviously, New Pacific is a big component of our value and in that value stack. And what's going on with New Pacific is to be honest, quite exciting, given that the flagship project is moving ahead into the permitting and mine planning stage. And this is Silver Sand that published its inaugural resource in 2020. But there's been a new discovery at another project called Carangas, which looks very promising, and waiting on some more news this summer. But certainly, it's starting to attract attention from what I would say, people in the know in the mining sector, in a similar way that Silver Sand attracted those kinds of followers and those people in the early days when Silver Sand was being basically discovered and developed. Right.
So, I appreciate that, and I think we've spoken to them. That is really exciting indeed. Is that maybe the opportunity here in a market like this? We're seeing a lot of cash-constrained companies too, meaningfully advanced ones. So you've got a sense of there's a lot of data on which to go on. You're not saying let's go invest in an exploration place, but are there many of those conversations going on? Those advanced profile? I know you've got 30 CEAs, but how many of those are kind of meaningfully advanced stories?
Yeah, I'd say out of that, to your point, we cut a lot of those and terminated the review. There's still a few that are ongoing that we're in discussions with and monitoring. Based on what the market is for those companies, there's a bit of even though we're all down, it's a bit of a relative trade. And so if there's an opportunity to pick up a company or a project that looks like a great development asset, and on a relative basis, yes, we might be depressed, but their share price is depressed. We can get a deal done, and then we can go and build a great project with that cash balance and the cash flow that we're generating. That's a way for us to, again, add another element to the story here.
Well, I think the shares are relative. Cash isn't. You've got it, they don't.
Yes. No, I'm saying, relative from the standpoint of if we're looking at that target's acquisition cost, the acquisition cost for that target, it's definitely down in absolute terms. And so that certainly would help in terms of negotiating a transaction. And I think from comments and conversations we've had, people that we've talked to recognize that taking our shares in a transaction where we're adding a new asset, a new element of the story, provides them with an opportunity to participate in a re-rate. So I think that that's something that we can provide to some of these project developers, where if they get taken out by some other companies, it might not have that big of an impact on the acquirer's share price. And so it really is, that's the deal.
Okay, brilliant. Well, look, Lon, thanks for introducing the story to me and our subscribers. Appreciate that. It's really intriguing position you find yourself in at the moment. Perhaps we could next time, if you come back on, do a little bit of digging around the kind of exploration, the organic component of your program. I'd be intrigued. Thank you.
Yeah, no, it's been a very, as I mentioned, it's been a big program, lots of time and energy, and then that is factoring into our planning, our decisions going forward on our existing assets.
Brilliant. Okay, Lon, appreciate your time. See you soon.
Thank you, Matt. Talk to you again.